So the second question of the past paper, September, December 2024. The first requirement is calculate G company's cash operating cycle 5 marks. So cash operating cycle or trade cycle uh, or cash cycle. So it all has the same meaning. 5 marks it is. So G company is a medium-sized company that manufactures a single product. The product should take 2 days to manufacture. Figures from its most recent financial statements are as follows. So revenue is given, inventory, raw material, work in progress, finished goods, trade receivables are given, trade payables are given. So credit sales account for 75% of the total revenue, and G company's gross profit margin is 60%. So this is important data for us. When we are reading it, we are not reading for the sake of reading. We are trying to link with the requirement. So cash operating cycle is basically all the inventory related days. Then we add the receivable days and then deduct the payable days. So this all data is relevant to those formulas. So G company has a large number of credit customers, but there is no separate credit control function, and chasing of overdue debt is left to the relevant customer account manager. So this is the point. Another point, the finance manager considered this would be satisfactory to enable the finance department to concentrate on more important aspect of the business. Standard credit terms for the customer is 30 days, and no credit accounts are currently suspended. All customers' account managers are paid a bonus based on the level of sales achieved. So raw material purchased the year total $2.16 million, and 90% was purchased on credit. Raw material is only supplied G company's purchases on credit. And then G company has always tried to maintain good supplier relationship, and average credit supplier days is 35 days. Okay, so they have given the credit days, supplier days is average is this. They have maintained it. Okay, the management of, now this is the cash management, which is not related to this part of the question. Then they say assume a 360 days for all calculation. So first of all, we need to know cash operating cycle includes the calculation of days, raw material days, work in progress days, and then finished good days, and then trade receivable days and trade payable days of the company. And for all that, we need, actually, you see here, they have given us the sales. The sales are total 6 million. Okay, so sales, credit sales are, we will write the data available over here. Then they say that credit sales are 75% of total revenue. So credit sales, which are very much important for us for number of calculations, so into 0.75. So that is the credit sales. Then they say gross profit margin is 60%. So 60% is the gross profit margin. So why they are telling us? Because we need cost of sales for calculation of raw material days and for calculation of payable days as well. So you see here cost of sales, how much it is? That is sales into 0.4. Margin is 60%. So the remaining is cost of sales. So we have calculated these three very important items with us. Now, so then comes, we have one more thing over here. Purchases are 2160. So, and credit purchases are 90% of it. So credit purchases, that is equal to 2160,000 into 0.9. So these are the credit purchases with us. Now, so raw material days are calculated how? That is equal to raw material inventory divided by purchases into 365, or here it is 360. So that is the formula we applied here. So 2160000 is here, that is purchases. Then is work in progress days. So work in progress days, the formula is, that is the progress days, that is equal to work in progress divided by cost of sales into 360. So we are applying the same. So work in progress is 20,000 divided by cost of sales. Here we go, into 360. So work in progress days are 3. Then is finished goods days. So finished good days, how to calculate? That is the inventory over cost of sales into 360. So these are the formula for finished good dates. So finished goods 80 divided 80,000 divided by cost of sales into 360. So here are the finished good days. Now the next is receivable days. So receivable days are average receivable 850,000 divided by credit sales into 360 divided by credit sales into, yes, because it is related to the now receivables and sales. Now then is the payable days of the company, that is equal to trade payables 162,000 divided by credit purchases into 360. So 162,000, yes. So 30 days. So here we have calculated all these. The formulas should be very much clear. So receivable days formula, I will be writing here for you as well. Receivable days formula, that is equal to receivables receivable divided by credit sales into 365. And for payable days, the formula will be equal to payables divided by credit purchases into 365 or 360, whatever it is. Here it is 360, so we apply 360. So now cash operating cycle will be, that is equal to raw material days, work in progress days, plus finished goods days, plus receivable days, minus payable days. So payable days has to be deducted from it. That is equal to 73 days is the cash operating cycle. Now, the next point. So this 5 marks calculation is already done. The next requirement is discuss why the 3 ways in which G company could reduce its cash operating cycle. And you see here very important points which we highlighted, that credit terms for customers are 30. Okay, and payable terms are 35. So are they utilizing it? Are they? No, you see here receivable days are 68. and people are utilizing 30. So two things they can do immediately. So first of all, receivable management. I'm sorry. So receivable days, which are actually as per credit terms, are 30 days, but they are actually taking 68 days, and it is lengthening the cash operating cycle too much. And since and lack of credit control department in company may be one of the reason behind it. One of the reason behind it. Now, so what they should do? So the customers who take more than 30 days to pay, their accounts, their credit account should be suspended before they make payment, start making payment until making payment as per terms of 30 days. One thing they should do. Second is payable days. Allowed payable days by suppliers are 35 days, but the company here is making payment within 30 days as calculated in previous part of the question. It is making payment. So 5 days are underutilized in terms of payable days. 5 days that they can reduce the cash operating cycle by 5 days without disturbing their suppliers and terms with them. So, 2 points we have discussed about payable days. Then you see here, one thing we discussed. Come here. One thing we calculated that work in progress days are 3 only. Means it takes 3 days to manufacture a good, a finished good. So raw materials are 20. So why they keep raw material too much in the inventory? So then is the raw material management. The company has work in progress of 3 days only, but raw material days are of 20, which is too much time to hold raw material without the need of the company and its production. So only 3 days. Now, so cash operating cycle can be considerably reduced if raw material days are reduced to 3 only. 3 as well. So 6 marks. You see, to the point as per the scenario. Remember the mistakes done by students. They try to write generic answer. Remember where you can write specific to the scenario and where there you are writing generic answer, you won't get any mark. So 6 marks, which our answer is speaking itself. So you have to discuss to the point as per the scenario. Okay? Now, so the next uh, part of the question is on the cash management. Using the Miller-Orr model, calculate the target cash balance for Guilmero company. 3 marks. So the management of Guilmero has decided it wishes the minimum cash balance to be 440,000, but the cash balance is volatile with a daily standard deviation of 15,000. Okay, so if the extra cash is needed, then they will sell tradable securities from an investment portfolio it owns. The transaction cost for a purchase is same as for a sale of $15 per transaction. Interest rate is 9%. So now the point is calculate the target cash balance. Now the point is target cash balance. How to calculate? For that purpose, we need to calculate the I'm sorry, that is the spread. So target cash balance they are asking for, and for that they have given standard deviation. Standard deviation they have given, that is of the cash flow, that is 15,000. And then they have given us interest rates which are annual. Which are annual interest rates. They have given 9%. And we need to calculate daily interest rate. So daily interest rate, that is equal to 9% divided by 360. So this is the answer in percentage. So daily interest rate. Okay. Now, the next point is transaction cost. They have given us $55 per transaction. Now, lower limit. They have given us lower limit of the cash balance 40,000. Now the point is, what is the upper limit? One is the upper limit. So for upper limit, we need to calculate spread. Spread formula we don't know. So the formula will be found in the formula sheet. So spread formula is here. Variance of cash flow is needed. So we need variance of cash flows, first of all, in the spread. So you see here, variance is equal to, that is equal to standard deviation square. It's square. Standard deviation square is called variance. Now, so once again, the formula for spread. So spread we will be calculating, that is equal to 3 into 3 by 4 transaction cost here into variance of cash flow, and then divided by interest rate, daily interest rate, then raised to power 1 by 3. So this is how it will be calculated. Where it has gone. Once again. So 3 into 3 by 4 into transaction cost into variance of cash flows divided by interest rate, bracket closed, and then raised to power 1 by 3. And here it will be the, yes, multiplication sign. Now I think it is okay. So here we are. So that is the spread. So spread is here in front of you. So now, so what will be the return point or target cash balance? Target cash balance, that is equal, the formula is here 1 by 3. I think it is given here. Yes, this is the return point or target cash balance. Lower limit plus 1 by 3 into spread. So here it is lower limit plus 1 by 3 into spread. So that is the return point or target cash balance, which is done for 3 marks. Very easy. Only you need to know the variables and simple formula is applied. Now, so what are the motives for, now this is generic question, for a business to hold cash? So there are 3 motives: transactive motives to hold cash, then speculative motives, and then we call it transactive motive, speculative motive, and precautionary motives. So one by one, we have to explain it for 2 marks. So transactive motives, I will tell you that the cash has to be paid for the regular business, for the suppliers, to make payment of wages, daily sundry expenses. So the business must have to keep that cash with them. So that is called transactive motive. Now, so then speculative or investment motive. Sometimes we have to write it like sometimes some investment opportunity arises unexpectedly. Some project comes to the limelight in terms of the company, in front of the company. So they have to make investment in that project. So they must keep sufficient cash balance with them so that they can exploit the opportunities, which will go away if they don't have sufficient cash with them. So that speculative and investment purposes, they have to earn abnormal return or good return, you can say, not abnormal. Okay, so they need some cash. And the third one is precautionary motive. Precautionary motive is that motive where, for unforeseen circumstances, some damage can occur, some claim can be filed against the company. Company can be penalized. Company may have to pay compensation to customer, to supplier, to employees, to authorities to avoid some damages, further reputation damage. So they need some cash in the company, okay, for these extreme circumstances. So just 6 marks, it is done. How it is to be written. Okay, so that's it. I hope you enjoyed this question. Take care.